Hello everyone, welcome to the market opening bell on Monday, July 21st, your 10-minute guide to the stock market. Hong Kong stocks rose for two consecutive weeks. The Hang Seng Index opened 258 points higher last Friday, then the gains narrowed to 131 points at 24,630 before expanding in the afternoon session, closing at the day's high of 24,825, up 326 points or 1.3%. The A-share index rose 133 points or 1.5% to 8,986. The Hang Seng Tech Index rose 89 points or 1.7% to 5,538. The total market turnover for the day was 238.6 billion Hong Kong dollars. For the week, the Hang Seng Index rose 2.8%, the A-share index rose 3.4%, and the tech index rose 5.5%. Southbound funds net bought 5.931 billion Hong Kong dollars in Hong Kong stocks last Friday. Among them, net buys included SMIC at $492 million, Alibaba at $388 million, Zhong'an Online at $236 million, Kingsoft Cloud at $235 million, Meituan at $202 million, Li Auto at $112 million. Net sales included Tencent at $362 million, Xiaomi Group at $299 million, Huatai Junan International at $233 million, Pokmart at $116 million. According to statistics, southbound funds have net bought Meituan for 10 consecutive days, totaling 7.665 billion. Net sold Tencent for 7 consecutive days, totaling 4.31 billion. Net sold Pokmart for 3 consecutive days, totaling 1.039 billion. It turns out that Korean retail investors are also enthusiastic about Hong Kong stocks. Data from SEI Bro under the Korea Securities Depository (KSD) shows that in terms of trading volume, from the beginning of this year to July 17, China ranks second among Korean investors' favorite overseas markets, second only to the United States. Korean investors are particularly fond of Hong Kong stocks. As of July 18, over the past year, the top 10 Hong Kong stocks by net purchase amount from Korean investors were Xiaomi, BYD, CATL, Alibaba, Laopu Gold, Pokmart, BeOne Medicines, Sanhua Intelligent Controls, Global X Hang Seng Tech ETF, and Ubi Tech Robotics. Technically, although the Hang Seng Index has not yet broken through the March high of 24,874, the closing index of 24,825 set a new closing high for the year and is expected to break through 24,874 in the future, testing 25,000 with the next target at 25,400. The tech index hit a new high since March 28th, and the next target could test 5,700. The three major A-share indexes closed higher collectively last Friday. The Shanghai Composite Index rose 18 points or 0.5% to 3,534. The Shenzhen Component Index rose 40 points or 0.4% to 10,913. The Chinex Index rose 8 points or 0.3% to 2,277. The combined turnover in Shanghai and Shenzhen was 1.571 trillion yuan, an increase of 31.8 billion yuan from the previous day. For the week, the Shanghai Composite rose 0.7%, the Shenzhen Component rose 2%, and the Chinex rose 3.2%. The renminbi central parity rate fell last Friday to 7.1498 against the US dollar, down 37 pips from the previous trading day. The People's Bank of China will announce the 1-year and 5-year loan prime rates today, expected to remain unchanged at 3% and 3.5% respectively. JD.com denied participating in the food delivery zero-yuan purchase battle, with its stock rising 3%. Alibaba and Meituan rose 2.9% and 1.4% respectively. Since July 5th, Meituan and Alibaba have simultaneously launched Crazy Saturday promotional activities, competing for orders through zero-yuan purchase coupons and through reduction red packets. Domestic media reported that Meituan invested 300 to 400 million yuan in subsidies on Saturday, July 12, while Taobao flash sale subsidies exceeded 1.2 billion yuan, with the two platforms combined burning about 1.6 billion yuan. The report noted that although both platforms drove order growth through coupons, the forms differ. Meituan mainly issues zero-yuan purchase coupons for tea drinks, snacks, etc. In the last two Saturdays, and some coupons are for self-pickup. Additionally, benefits vary by membership level, which dilutes costs to some extent. Meituan issued about 20 million free order coupons in a single day, of which over 10 million required users to add other items to meet the minimum delivery threshold after using the coupon, and another 10 million were self-pickup orders settled at lower prices between Meituan and merchants, thus reducing subsidy costs. Taobao flash sales coupons are all for delivery full reduction offers, such as 18.8 off and off on 18.8, 18.8 off on 28, or 10 off on 20, where users pay a small amount for delivery order, and self-pickup after ordering is not yet supported. In response to the competition between Meituan and Taobao, JD Group recently stated that its food delivery, zero-yuan purchase, and other malicious subsidies represent severe involution and vicious competition, and they are not participating at all. Regarding reports of Douyin launching a group-buy version of food delivery, Douyin responded that Douyin Life Services focuses on in-store business and has no plans to build its own food delivery. Currently, after Douyin users purchase flexible group coupons, they can choose in-store verification or home delivery. Great Wall Motor announced its performance flash report for the 6 months ended June 30, 2025. Net profit attributable to shareholders was 6.337 billion yuan, down 10.2% from the adjusted net profit of 7.058 billion yuan in the same period last year, with earnings per share of 0.74 yuan. During the period, the total operating revenue rose 1.03% year-on-year to 92.367 billion yuan. Data shows that consumer inflation expectations have improved, but US President Trump is pushing for higher tariffs on the EU, leading US stocks to open high and close low last Friday. The Dow fluctuated lower, falling as much as 259 points, closing down 142 points or 0.3% at 44,342. The S&P 500 closed nearly flat at 6,296. The Nasdaq rose slightly by 10 points to 20,895, marking 5 consecutive days of gains. For the week, the Nasdaq rose 1.5%, the S&P rose 0.6%, and the Dow fell 0.06%. The Nasdaq Golden Dragon China Index, reflecting Chinese concept stocks, rose 45 points or 0.6% to 7,728 at close. Large tech stocks generally performed well, with Tesla closing up 3.2%. Apple and Amazon rose 0.6% and 1% respectively. Nvidia, which has repeatedly hit new highs, finally fell 0.3%. Microsoft also fell 0.3%. On the earnings front, Netflix reported second quarter net profit beating expectations, but its stock fell 5.1%. 3M reported second quarter revenue beating expectations and raised its profit guidance, but its stock still fell 3.7%. Its second quarter adjusted earnings per share were $2.16, above the analyst average expectation of $2.01 Adjusted operating margin was 24.5%, above the expected 23.6%. Total revenue was 6.16 billion US dollars, above expectations. 3M's adjusted earnings per share for the year will be between $7.75 and $8, including the expected tariff impact. It also lowered its expected tariff hit on net profit for the year from 20 to 40 cents per share to 10 cents per share. On economic data, the July preliminary University of Michigan Consumer Sentiment Index rose to 61.8, above the expected 61.5 and June's 60.7. One-year inflation expectations fell for the second consecutive month, from 5% in June to 4.4% in July. Long-term inflation expectations fell for the third consecutive month, from 4% in June to 3.6% in July, both figures at their lowest since February 2025. June housing starts annualized at 1.32 million units, up 4.6% month-on-month, exceeding the expected 1.298 million, with May revised to 1.263 million, down 9.7%. June building permits annualized at 1.397 million units, up 0.2% month-on-month. This week, there are three key variables for U.S. stocks. First, progress in the Trump administration's tariff negotiations with various countries. Second, economic data, including for July S&P Global Manufacturing PMI preliminary, June durable goods orders, new home sales, existing home sales, etc. Third, corporate earnings, with companies reporting this week including Alphabet, Tesla, Intel, IBM, Texas Instruments, Coca-Cola, General Motors, Southwest Airlines, American Airlines, etc. Our stock pick today is BeOne Medicines, stock code 6160. BeOne Medicines will announce its second quarter results for this year on August 6. Its first quarter delivered another strong performance, with total revenue reaching $1.1 billion, a 49% year-on-year increase, primarily driven by sales growth of Brukinsa in the US and Europe. Brukinsa is now approved in 75 markets globally, with new inclusions or expanded reimbursement in 11 markets during the first quarter, including Japan, Europe, and Brazil. Its global sales reached $792 million, up 62% year-on-year. The US remains the group's largest market, with product revenue of $563 million, a 60.4% year-on-year increase, where over 60% of the quarter-on-quarter growth came from expanded use in chronic lymphocytic leukemia (CLL). Brukinsa leads in the treatment of CLL and all other approved indications in the US, with its market share continuing to grow. In Europe, Brukinsa's first quarter sales reached $116 million, up 73%, driven by market share gains in major European markets including Germany, Italy, Spain, France, and the United States and the United Kingdom. Another product is Lilismab. It's approved in 46 markets globally, with reimbursement added in 11 markets in the first quarter, including the US, Europe, and China. Its first quarter sales were $171 million, up 18%. Additionally, products licensed from Amgen contributed to product revenue growth. In the first quarter, the group achieved profitability under US generally accepted accounting principles (GAAP), with significantly improved operating cash flow. GAAP net profit was $1.27 million, a substantial improvement from $251 million loss in the same period last year, driven by revenue growth and improved operating leverage. Adjusted net profit was $136 million, compared to an adjusted net loss of $145 million in the prior year. The first quarter GAAP gross margin was 85.1%, up 1.8 percentage points from the previous year, primarily due to Brookins's higher share of global sales compared to other products in the portfolio. Gross margin also benefited from improved production efficiency for Brukinsa and tislelizumab. The group maintains its full year 2025 revenue and expense guidance, projecting total revenue of $4.9 billion to $5.3 billion, with gross margin expected to range between 80% and 90%. With a diversified global business spanning 6 continents, the adoption of the new English name BeOne Medicines, and the relocation of its registration to Switzerland, the group is advancing toward becoming one of the world's most influential oncology innovation companies. The suggested buy price is 176 Hong Kong dollars, with a target price of $194 and a stop loss at $165. I do not hold the aforementioned stock.